This video is mainly going to cover stocks, and the first chart I have here is the New York Stock Exchange, and what we have here is basically 2011 and 2012 prices. There was a decline in 2011 from May to October, and since then we had an initial rally in October that retraced almost exactly 61.8% of that decline. Then we had a decline that followed, and then a rally that has now peaked very near the 78.6% retracement of that initial decline. That's an idealized Gartley pattern. If anyone has ever studied that, it's something I've studied a lot in my days here, and that's the formation I like, is the 61.8 and then the 78.6. Now we have the uptrend line from the low of the pattern to the low of the what would be the B wave of an A, B, C type of pattern. That's now been broken. It was also broken with a gap down, which is always more significant in my opinion when the trend line is broken with a gap down. Now from this point, we've had a decline, and let me click over to the Russell 2000 for a minute. The daily charts are showing stochastics just coming off of oversold levels now on the indexes. So it's likely that the market may put in a rebound here. And I've studied this in great detail on individual stocks. And once the high is in on a pattern like this, and then the market declines, and the stochastics become oversold, a little more than half the time on individual stocks, there is a rally that will take the price back up enough to allow the stochastics to go back above 50 and then make a bearish cross. And that will typically happen in the price levels defined by this box here. Primarily this being the low and this being the high. So the huge majority of time, let's say somewhere around 70% of the time, that stochastic cross will come between here and here. So we're right in that box now. It will often happen sooner rather than later. So what my expectation here is, even though this is an index and my studies have been more on individual stocks on this, I would say there's a possibility that now the market is oversold, there's an unfilled gap down above, and the stochastics has not, if we look at the Russell 2000 again, the stochastics is just coming out of oversold. It might take 3 to 5 days for it to get back above 50 and be ready to cross down again. So we may expect some continued rally this week or into next week before possibly a nice short sale type of setup here. Now I'm going to click over to the SPY chart. This is an hourly chart of SPY, and this was the recent high on April 2nd, and SPY declined down to this level. There was a gap down in the middle of the move, which happened exactly at the 61.8% retracement of this move down. There's been an initial move up that went right to the 50% retracement level, followed by a decline. And if we look at the external retracement of this decline here, assuming the market moves into a new high, the external retracement 141.4% level overlaps that 61.8% level and is at the unfilled gap. So that's a potential resistance zone or harmonic resistance zone right at that level. And then also if we project this advance here from low to high, project that up from the recent low, that also puts us right in that gap zone. So if the market does rebound a bit from here, which it looks to me like it will, the hourly stochastics chart is just coming off of oversold, and there's a bit of a bullish divergence on the MACD here. I would look at prices coming up into this level as a potential area to take short signals, assuming you get some type of a reversal there. Now there also is a unfilled gap down here above the trend line, but I wouldn't necessarily expect that one to be filled because it's above the trend line, but we might expect this one here to be filled before prices continue the downtrend. This is the chart of the Dow Industrials, and the thing I wanted to point out on this chart is, again, it's also below its rising wedge line here. So once that wedging pattern is broken, it opens up the possibility for some larger declines, and the price logic here has shifted to down, in my opinion, at least for the intermediate term. There was a significant 4 or 5 day correction here into March 6th, and then there was a rally for about 3 to 4 weeks there, and actually peaked right here, slightly above that day there. And then the move down we saw in 5 days off of this high completely retraced below the March 6th low, in less time than that rally took to form. So considering the weakening at the end of this pattern, the bearish divergence in the indicators, and then the fast retracement of that pattern, it looks to me that likely a new pattern started from this high here, and we've had maybe an A wave down or working on a B wave, and the likelihood is probably that we're going to see some lower lows below that level. Now, if that happens, if you have a significant low and then you have another significant low which was immediately regained, so it broke the low and then regained it, if the market comes down and breaks those lows again, oftentimes that'll be a continuation point, and just looking at it like a double top or a head and shoulders type of pattern, we would at least expect a move equivalent to from here to here projected down from the break of that neckline, so to speak, there. So that's what I'd be looking for, at least a move down into these areas here if this low is broken. This is a chart of Apple, and this is a stock that I don't know that I've ever actually traded Apple, but I follow these bellwether type stocks because it's the largest weighted percentage of the stock exchange, basically. So when you look at these type of stocks, they're going to pull the market with them. And what we've seen on Apple is really an amazing run. The stock has almost doubled in the last 4 months, 4.5 months from November. Slightly less than doubled, but a tremendous move. The daily stochastics has just been intertwined in the overbought area. Very, very strong move. On a weekly chart, it's very, very overbought. On a monthly chart, it's very overbought. And I've showed this before, but the stock, this red line is a long-term trend line on the top of a wedge type of pattern, which the stock broke through that. And then this light red trend line here is also kind of the upper channel line of a blow-off top here. So the stock is still above those levels, but I would look for it to at least fall back into those levels. And if it does come back down below those levels, the stock may have a very, very significant correction in it. I don't have the volume pulled up on this chart, but volume has been very heavy on the last several days of this decline, and this decline here has been more significant than any of those small corrections since November. So there's somewhat of an overbalancing, meaning this is a more significant price break than any break before, and that's very typical. When a trend ends, is you're going to see a larger and faster, or larger, faster, and more time-consuming correction than any in the prior leg up. So I do think that it's likely that Apple has topped and is going to make a significant correction here. Whether that's a major bull market top or not, I think it's very possible that it is based off the long-term trend. But in any case, I would look for, even if we do get some short-term rebound, continue to look for this stock to trade lower. There's a significant unfilled gap here around the 420 level, and that's at the 78.6% retracement of the move up since November. This line here is just showing the kind of base trend line of this low and this low off of that leg up. So it may decline into that trend line, find support a little bit, and then if it breaks through it again, we would probably see a relatively sharp move down. So again, I think that fits with the idea here that the market may see an initial rebound, but if we break the recent price lows, we'll probably see an acceleration of the decline, and I think Apple will end up getting hit pretty hard from these levels.